Investing is a loser's game. So what
Sorry. Please expand.
I know people who didn't even apply, saying कि अपने भाई भतीजे को देंगे, तुमको क्यों देंगे?
I'm also kind of guilty of, but many of our listeners also would be.
Right.
Which is how following successful investors may actually set you up for failure.
See, the point is you don't know in advance which will be the multi-baggers. Are they doing what you think they are doing? People think they want to follow. So people think that he buys and holds.
Yeah.
But what is the actual data? You have to ask that for all the people who followed a strategy, what happened to them? Many times if you go back, before that, the portfolio had gone down 80%. So if you're down 80% and then you compound 50% for 3 years, you're still down.
Hi friends, welcome to another episode in our podcast series. And after much persuasion, finally we have Devina Mehra on our podcast. Devina, welcome.
Thank you so much.
So Devina, for those who would not know, is the founder, chairperson, and managing director of First Global. And First Global itself has had a kind of evolution in its history. Started as a broker, then an international broker, and now a full money management firm. So we'll talk about it. But I think the most interesting thing that I would like to talk about is Devina's book. So Money, Myths and Mantras by Devina Mehra. Now it's a national bestseller. So many congrats, Devina.
Thank you so
And
much.
more than congrats, I would like to say thank you, because I found the book really fascinating, both from a new or a beginner investor standpoint as well as a seasoned investor standpoint. So there are kind of ideas that all of us can pick, and we will talk about some of these. But before that, I must say Devina has had a long and wonderful career. Started with IIM Ahmedabad, then Citibank, then I think just after 7 years in Citibank, you started on your own, which is quite early, startup-ish.
I was still in my 20s. And at that time, there was no term or cachet about startup or business.
Yeah, so some of the, original
and no funding either.
Yeah. So what prompted you to get into your own? And, I'm sure you would be doing quite well in your professional career.
Yeah, so actually I'd been looking for a change. So I was exploring, because for me, the big thrill in life always has been, from the time I was tiny to now, has been learning. So at some point you feel learning is tapering off. And also I found, Citibank was a very political, very internally competitive place, which temperamentally did not suit me. I can say I did not like playing games, but the fact is I'm incapable of playing games. So I'm pretty much, what you see is what you get. So between all those things, I was exploring, to the extent that I remember I went and met the director of what was then the Prince of Wales Museum, ki, kya interesting cheez kar sakte hain. I went and met the Economic Times editor, what are the things that are possible. And while I'd applied for a PhD, I knew that was not something I wanted really to do, because while I love learning, it is not, I like to learn a wide variety of things. So, one problem in that much detail was not something. So then along came this is early 90s. So there were two things. One was, at that time, NSE was not there, SEBI was not there. So the Bombay Stock Exchange was the largest exchange in the country, and they advertised saying we will give 71 new memberships to professionals. And this was at a price of 55 lakhs, which of course was very high, but it was a quarter of the market price, because the market price of a BSE membership was about 2 crores.
Okay.
So that was one. And the other was Dr. Manmohan Singh's post-liberalization budget, where he said now the market will be open to foreign investors.
Yeah.
And I said, now the market will professionalize, because prior to that, there was no concept of equity research. The profession did not exist. So much so that in IIM Ahmedabad, we didn't have a course on securities research, because that career did not exist. So these were the two, kind of immediate prompts. And the BSc card, everybody told me don't even apply, because BSc was a broker's club.
Yeah.
And that too 80% Guju, 20% Marwadi. They said you are a total outsider, a woman on top of that. I know people who didn't even apply, saying कि अपने भाई भतीजे को देंगे, तुमको क्यों देंगे? So, I said apply करते हैं, let's see. So I always say this whole thing of manifesting your goals, that BSc card was the biggest example that it happened. And at the end, I got 2 extra marks for my IM gold medal. And that pushed me over the cutoff. So I said, fine, I mean, this is not a list I need to top. I have to be there. So I was number 69 in the 71, but I was there. So,
and I'm kind of remembering that Steve Jobs commencement speech where you can only connect dots looking backward.
so much so much so. I mean, even for that BSc card, I remember, see, in Citi, I was 5 years in what was then called merchant banking, part of investment banking. So all and 2 years in corporate credit and risk. So in merchant banking, after 2 years, I thought I've learned what I had to learn, let me move out. But somehow, for one reason or the other, it kept getting extended, and I ended up spending 5 years. But when I applied for my BSc card, they needed capital market experience, and the only department in a bank that counted was this merchant banking. So that's what, like, really dots connecting in hindsight, and the gold medal. Yeah. So,
So maybe we'll keep on coming back to your career, but I really wanted to talk about
yes,
book.
of course.
So Money, Myths and Mantras, as I said. So although it's a fascinating book and there are a lot of topics that we can possibly spend the entire day talking about, but for paucity of time, I've picked up 3 topics I really wanted to talk to you about. The first one is the first one. So there is something you call the 4-thumb rule for your financial health. So let's talk about this.
Yes. So, I mean, I want to tell people, because everybody has a day job. They are working somewhere, or they're running their business. And this is obviously, for most people, investment is not a full-time job. And that becomes kind of a mental block, that how do I do this? Maybe I don't understand it enough. So the important thing is to do the basics right, to get the broad parameters right. And if you do that, you will be 80-90% of the way to optimization. So you don't have to wait for optimization. First is asset allocation. So this is very important. It sounds very fancy if you are not from the finance world, but it's pretty simple. It is just that categories of assets. So how much is in equity? So equity means both direct equity as well as anything you're holding through mutual funds or PMS or anything like that. The second is fixed income. So that's fixed income mutual funds plus other things. Fixed deposits, PPF, some savings scheme, all the tax saving schemes you do. So all of that is in that. Though, of course, I mean, fixed income mutual fund, there's a whole gamut of things. So don't be on the risky end of that. That's another thing. Then there is gold. There is real estate, whether anything you bought yourself or something that has come to you through inheritance. Might be some alternative assets also, like crypto or art. So, and as in Google Maps, you don't just put the destination, you first put the starting point. So know where you are invested today. And of course, the liabilities, house loan, car loan, etc. And then take a decision of where you want to be. So be deliberate about your asset allocation, because often people have no idea what's going on. And let alone individuals, I've had family offices who will tell me we are mostly in global bonds. But when you actually draw up everything, you will find the biggest investment is in Indian real estate. So you have to be clear where you are, and therefore take a deliberate decision on your portfolio. Even within equities, I mean, people have no idea how their equity portfolio is, because you've just bought something you heard from a friend, something you saw on TV. You don't know how many stocks you are holding. You don't know what's the sectoral allocation, because again, very often it happens that you let's say holding mainly in 2 or 3 industries, if you actually draw it up. And also you think you are buying stocks with XYZ characteristics, this much growth, this much PE, this much return, whatever your thing is. But when you look at your actual portfolio, it might look very different. So be deliberate about these things. Be deliberate.
So 4-thumb rules. First, you spoke about asset allocation.
Right.
Second is take a portfolio approach to investing.
Right.
And the third one is, if there is one god in investing, it's risk management. So it's quite a profound statement.
Yes. I mean, that has to be the key thing, because investing is a loser's game. So what is
sorry. Please expand.
what is the loser's game? I mean, you can all Google this article called the loser's game. It's only about 4 or 5 pages, but it's a mind-opening, eye-opening article. It is late 70s, Charles Ellis. So it's always been part of my training manual, because so everything in life is a winner's game or a loser's game. And what that means is that you have to play the game of investing not to lose. So that has to be your primary objective. So not to lose doesn't mean that you will not make losses.
Yeah.
In fact, you have to take the small losses in order to ensure that your capital doesn't take a big hit. So risk management is essential, because percentages are not symmetrical. If your portfolio falls 50%, it has to go up 100% for you to come to zero.
Yes, yes.
So sometimes, for example, in small caps, people will say, oh, so and so has compounded 50% last 3 years. I said many times, if you go back, before that, the portfolio had gone down 80%. So if you're down 80% and then you compound 50% for 3 years, you're still down. You're still down about, I think, 25-30% at the end of it. So don't forget your school mathematics.
Yeah.
So a loser's game. And games change. So, for example, aviation at the time JRD Tata was flying was a winner's game. It was an adventure sport. When that Karachi-London flight of his, at times he missed altogether the town where he was supposed to land, and he landed in some disused World War I strip. There was some part didn't work. He wound a wire and made the plane fly. Now there's only one way to fly a plane. Go by the checklist, make no mistakes. So investing maybe in our grandparents' time was a winner's game, when nobody knew. You could find gems which nobody had heard of. At that time, even till the 90s, it was difficult even to get hold of annual reports. But now it is a winner, it's a loser's game, because now information is available.
In fact, too much of it.
So now you have to play, and plus all the brightest minds are here, so-called. So, therefore you can't say that I will always be the best one to find gems which nobody else has found. So now you have to play, first of all, not to lose. So some of the basic things you can do in risk management, one, of course, asset allocation, which means that never put 100% of your money in equity. That is one. Within equity, again, make sure that your sectoral allocations are not just to a few industries, because basically most companies in an industry move together. So if even if you have 15 stocks but only in banks and FMCGs, more or less like having 2 stocks. So that is the basic thing you must do. And whatever is your parameters, even if they are simple parameters, even if you have 5, at least keep to that. So some of the basics, and always have a stop loss, yes. And that's a trailing stop loss. So let me just quickly explain trailing stop loss, because I found even professional investors have told me, oh, I learned this concept from your book. I said, I mean, like you're doing this. So if you buy something at 50 rupees, let us say, and we use a more complex thing, but let us say you have a 25% stop loss. So it doesn't mean that your stop loss gets fixed at 37.5. What that means is that if from 50 your stock goes to 100, I never say that I will sell if the stock becomes 100 or 150, because then you are saying that then you let go of the multi-baggers, and you don't know upfront which are the multi-baggers. So that's a chapter in my book also, that anyone who tells you that they know the secret sauce to multi-baggers, that no one knows, not Warren Buffett, not Rakesh Jhunjhunwala, nobody. But the point is that so if it goes to 100, goes to 90, you continue to hold. It goes to 150, becomes 120, then goes to 200. But when from 200 it comes back to 150, that means that from the high it has now fallen 25%.
What is the peak from there? 25%.
So then you get out. So keep to the discipline. Don't think that I will decide when the market falls what to do, because then you will freeze. So as far as possible, put things into a disciplined, systematic approach. And then, of course, the
last one is diversify globally.
Yes, this is so important, and this is one thing which is often missing from Indians' list, because every country there is a home country bias. So Canadian investors might be investing 60% of their money in Canada. Canada is not 60% of the world market cap. But first of all, asset allocation, when we say 85-90% of the returns come from asset allocation, that's not just asset allocation within a country. It has to encompass all assets. globally. And India is less than 5% of the world's market cap. There's no reason why 90% of your investment should be here. There's absolutely no reason. And in fact, you already have a lot of exposure to India. Your real estate is here, your job is here. So at least try to diversify the investments. At least have 30-40% of your investments over a period of
And
time.
we have seen the kind of wealth, some of, especially over the last 10 years, some of these mega tech companies, other companies also, but mega tech companies have created, earlier it was Fang, now it was Mag 7. So obviously, if you did not take exposure there, you missed out.
It is not as narrow as that also, Rohit, because it is over a period of time. I mean, one statistic I always give is that when I started working, the dollar was 12 rupees. So in the course of less than a career, you've seen a 90% depreciation. So when you're talking of saving for goals which are 10, 20, 30 years away, you cannot forget this part, that the rupee depreciates and therefore your portfolio depreciates in real. And also don't put all your eggs in one basket. We went global. We were not just the first Indian firm, we were the first Asian firm other than the Japanese to go west. So in 1999, we were the first Asian ex-Japan members of the London Stock Exchange, next year of the NASD. So why, I mean, did we go global? One of the triggers was, and everybody told me that this can't be done. Nobody will listen. You can't be from India and say you will cover.
So career has been a career of firsts in many senses.
So this was the interesting part was this, that the reason why I went global, one of the main triggers was, which will be in history books for most of your viewers, the Asian crisis of the late 90s. So in 1 year, all these markets fell between 50 to 90% in dollar terms.
Asian tigers.
Asian tigers. So that's what, I mean, sometimes people say that, oh, if India is the fastest growing economy in the world, why should I look elsewhere? Do you remember which were the fastest growing economies in the 1990s? They were the Asian tigers. India wanted to be an Asian tiger. And then there was this crisis. So, Taiwan fell 50%, Indonesia fell 90%, all the other were between 50 and 90. So Thailand, Philippines, South Korea. I said, this is the danger of being in one market. And during Citibank times, I had spent 6 months in Indonesia. I said, Aaj Indonesia mein hote to 90% of your net worth was gone. So that was a wake-up call. Other than the fact that I said, like, kab tak wahi companies karte rahenge. So let me, learn about some other companies. So, but global investing is so important, which is why, I mean, because it's a cause for me. And global again does not mean the 10 stocks in India and the 3 stocks in the US and the 3 stocks in China. Global means global, because again leadership changes. No theme lasts forever. No asset class, no country, no region, nothing. No sector within a country. So if you look at 2003 to 2007, for instance, now US was not at a high. US was already down in the dumps after the tech crash of the early 2000s. But still that whole 5 years, it hardly gave any performance. Whereas in those 4.5 years, India went up 6 times, Brazil went up 10 times, the whole emerging market index went up 3.5, 4 times. So just because last 10, 12 years US gave return doesn't mean that will always be the case. So you have to be truly global. Because earlier, the only way to get, and the reason why Indians are that much into home country is also partly because earlier you could not invest abroad.
Was not there.
You were not allowed to. People laugh when I say that, like, even 5 years after I started working, or maybe a little longer than that, all you could take, if you were traveling abroad, so let's say to London or New York, you could take only $500, and that too once in 3 years. If you went more than once in 3 years, you could take only $20. So that was the, so our grandmothers were not wrong in buying gold, because gold was effectively the only currency hedge.
And global currency.
Only that was the only rupee hedge you had. So if you look at the dollar chart of gold, it is more volatile than equities. The 1980 price of gold in dollar terms was not reached again till 2007, for 27 years. In between 19 years after that, it was down 60% still. In 1999, the price of gold in dollar was 60% less than what it was in 1980. In rupee terms, it looks like an okay chart simply because it's a rupee depreciation chart. But now The liberalized remittance scheme means you can send abroad $250,000 per person per year. So, I mean, a family of 4 can send out $1 million every year. So, more than anybody needs other than the family offices. So, but mindset is still India only.
Yeah.
So, you have to broaden that.
Great. Let's come to the next point, and this is something I would say I am also kind of guilty of, but many of our listeners also would be,
Right.
which is how following successful investors may actually set you up for failure.
Right.
Please enlighten
So
us.
actually, this is one of the longer chapters in the book, so it has many points. But a few key things. One is that are they doing what you think they are doing? And the example I've given is of Warren Buffett, not because he is the worst example, but he's the most well-known investor, and one people think they want to follow. So people think that he buys and holds.
Yeah.
But what is the actual data? That he sells more than half of the stocks he buys within 6 months, 85% within 2 years. That's the data.
Wow.
So, so are they doing what? And even in other things, you think he's buying cash generating big brands, very cheap. But again, I don't know exactly what the number is now, but his Apple holding was over 50%.
Yeah.
Almost 50%. So that's not the profile you think he's buying. Then are they even successful? So Warren Buffett, even for as long as 20 years, his returns have been around the S&P. A year ago, they were a little below the S&P. Maybe now they're slightly above, but around the S&P. But there are others like, for example, Ray Dalio, who people like to follow. Yeah. His performance has been absolute disaster, even when you take a 20-year period. There's nowhere close to even the S&P. So are they even as successful as you think they are? And also Warren Buffett in the Berkshire Hathaway, a lot of the money has been made in things like structured deals and derivatives and not in these value picks. And which is true of every big investor, including Rakesh and all that, that the returns have come from a handful of stocks. So Warren Buffett's investment career is something like 70 years, and he said maybe 10 or 12 stocks have given all the returns.
So in fact, we talk about Apple. Recent data I haven't checked, but last year I was reading that all the money he has made in all the stocks combined, Apple has made more money for him.
Right. And but he would see, the point is, you don't know in advance which will be the multi-baggers. Yeah. So if you, for example, Rakesh Jhunjhunwala, if you met over the years, he would talk of many stocks. He also did not know that all my money will be made in Titan, Crisil, Lupin, and maybe one or two others. But that's not known upfront. I mean, the trajectory of the company is not known upfront. I mean, very recently I read a book by Titan CEO called The Tanishq Story. Yeah. And you read that and you realize that this was a company that went through absolute ups and downs. I mean, so many times it came to a point when they were deciding whether to shut down the.
Yes, I read that book.
So that was the company trajectories are never linear. Stock trajectories are never linear. So nobody knows in advance. The other really important thing is that if you say that so and so has become rich in the stock market, so let me see what they did and let me follow that path. In itself, this is a wrong question to ask. You have to ask that for all the people who followed a strategy, what happened to them. So for example, if you have a very high risk strategy, so if you have a strategy which, let us say, if 100 people start, at the end of 1 year, 90 would have gone bankrupt, but the 10 people who are left will have made 10 times the money. Yeah. So you play this thing in 5 rounds. So in 5 years,
just one person will be
there who would have made out like
immense money,
and everybody else would have gone bankrupt. Now you said this guy has made like whatever 100 rupees into 1 crore or equivalent. So let me follow this person. But of everybody who followed a strategy, what happened to them? So if you look at for example, if you follow a very high risk strategy, which has that, like if 100 people start playing that game, at the end of 1 year, 90 will go bankrupt, 10 will have their money go up 10 times. Yeah. So if you do that, then you play that for 5 years, at the end of it, there will be only 1% left. But that 1% would have made like 1 lakh into 10,000 crores or something like that. And now you will say that this person has done this, so let me do exactly what they did. But if you do that, there's a 99% chance that you will go bankrupt. So that's the thing. So you have to look at not what did rich people do or successful people do, but of everybody who followed a strategy, what happened to them. So Rakesh also, I remember somebody asked him in an interview that you made your first round of money through trading and now you tell people not to trade. So, why? So he said, like, I might be smoking, but I tell my children not to smoke. So it is like that just because it worked for me doesn't mean it was a good thing to do.
No, and there are dedicated forums and blogs and so many handles on Twitter who are just following what other investors are doing. And, it's kind of a wake up call. And, again, one point which I would like to add to what you said, that what a successful investor is doing, that trade actually might be a very small part of their portfolio. It might be a large part of my portfolio.
Yeah, and also you don't know what they are actually doing. What you will know in the market is only parts of what they are doing. You don't know the real picture in real time as to exactly what they are doing.
Yeah, maybe a trade is a hedge against something else.
Yeah, I mean, you don't know and what their position is, what their other positions are. So there's so many complexities. So it is a useless thing to do. And in general, since you talked of forums, this is a separate chapter in the book on crowds, that should you discuss or should you not discuss your trades and or for that matter any kind of decision making, even corporate decision making, should you discuss around a table and come to a decision. And actually there's a very simple filter for that elaborated it in the book, that pooling independent opinions improves the quality of decision making. But discussing things actually brings down the quality of decision making, because you get influence, that who's more powerful, who's the boss, who speaks first, all those things. There are many interpersonal dynamics that come into play. That's why there's a book called The Wisdom of Crowds and a book called The Madness of Crowd. So is the crowd so is the crowd wise, or is it crazy? And the real filter is that whether the opinions are independent or you are getting carried around with the map.
Yeah, it's a crowd thing or not. No, so fascinating. And maybe we'll come to the last section in today's discussion, which is and you've devoted a whole section to it, which is future of investing and AI, tech, etc. All of this, and how do we as individual investors kind of prepare ourselves for the future of investing?
So I'm not talking AI or machine learning and all these things because it is available or because it is fashionable. So we briefly spoke earlier about information.
Yeah.
That earlier information used to be the issue. So, I mean, I loved the 90s when I started on this securities research thing, when nobody knew what securities research was. You'd call up a company and say, I want to meet you. They would say, why should we meet you?
Yeah.
No, like you come to our AGM at the most, especially the conservative groups would not meet at all. No company had a investor relations department.
Yeah.
And even when they had, there used to be this thing. And I'm not even talking small companies. But now, by law, every information, including analyst call transcripts, have to be there on the website. So everybody has the information. So now the edge has shifted. So it is no longer getting the information. And this is not true just of India. Even in the US, a Fidelity could sit in a room with a IBM or a Procter and Gamble and get differential information. Now, by law, over the last 20 years, every country has outlawed that.
Yeah.
So all information has to be given to everyone. So now what happens? Now you have, as you said, too much data.
Yeah.
So now the skill set has moved from getting the information to analyzing the information, that who can analyze these masses of information. So that's where AI ML comes in, because what does it do? It does, one thing is obvious, that it can analyze many more companies or stocks. Like globally, we analyze something like 23,000, 24,000 stocks.
Is it even
securities
possible to analyze so many stocks?
That only through the machine, because even if, let's say, I had 1,000 analysts, they wouldn't look at everything in the same way.
We'll analyze the 1,000 analysts then.
So this plus number of factors you can look at within a company. See, I've done it the old-fashioned way, so I know at the most, actually, only 4 or 5 things you will look at the end of it. Here, you can look at as many factors as are relevant. And you can also test out, for example, we normally look at growth of profits or sales. That's a first derivative. So that's kind of velocity. So you can take the second derivative, which is acceleration, or the third derivative, which is called jerk. And you can test it out whether the signals are coming through the higher derivatives. And if so, you can incorporate it in your system. Then also, no company is great on all parameters or terrible on all parameters. So how do you combine that? So all this also the machine helps you do. But the really important thing, and which is an area which I've studied in the last 5-10 years, honestly, is that it takes away the human biases and the randomness that human beings bring. So one of my favorite authors is Daniel Kahneman.
Yeah.
So his 2 books are among my all-time top 5, and I read a lot. And it's really about how human beings, when they come in, they introduce.
One is blink.
No, not blink. Thinking fast and slow and noise. So that is the thing that when human beings come in, they bring in a lot of biases, and which are so hard-coded that you can't get rid of them. I mean, he worked in this field for 70 years. He won the Nobel Prize for his work. And he said, I find my decision-making has barely moved because it is so hard-coded that it's not just by intellectually understanding now I will be able to eliminate the bias. Very few you can do that way. So that's why the machine comes in. It removes randomness. I mean, all of you can understand that if, let us say, I have 20 analysts, each with 15 years of experience, and I give exactly the same data to all of them, they will have different opinions, or a fund manager.
Absolutely.
Or for that matter, if you have a fight in the traffic or a fight with your spouse in the morning, you will look at the same data differently. Yes. I mean, they've even done analysis, like, for example, if you want bail, if you appear before the judge before lunch, you are likely to get rejected. After lunch, you might get relief. Okay. So this is how random human beings are. So the machine does all this, and the machine learns. So again, human beings hate to admit mistakes. The machine is indifferent to whether something was a success or a failure. It will learn from either. So there are many things like that the machine brings in. And you talked about being the first. Yes, for many things I was the first, but like for launching the PMS, I can say I was almost the last. I mean, in the sense that I launched 25 years ago, even though we had got the license 25 years ago. And why was that? Because I wanted some predictability, some forecastability about how my money management would do, rather than do it just I like this stock and I buy this stock. And that came with the machine, that you have predictability, you have consistency. Okay. You, at least on a risk adjusted basis, you know how it will perform.
So I was asking you this before we started recording, is how your company has kind of moved from being a sell side house to now a money manager or an institutional investor. So if you can just maybe throw some light how that thinking.
Okay, so there were like 2 or 3 things that happened. We talked about getting the BSE card. So after that, in the 90s, we became very large institutional brokers, almost entirely dealing with foreign institutional investors, because at that time anyway domestic mutual fund industry was not really there. So that was the 90s. Then toward the end of the 90s, we spoke about the next big change was going global. And everybody told me that no one will listen to you, you are a nobody. And that was a very gratifying period for me personally, because people said that if you want to go west, then do the smaller stocks which nobody is covering. I said, I want to go to the big markets and do the big stocks. So that's what we did. And here, at least, you also, you might know the journalists, you might know the editors. There you knew nobody. So it was only your work going out. Yeah. And in no time, we were in Forbes, Fortune, Business Week, Wall Street Journal, front page, Barron's, everywhere, just on the quality of the work. So it didn't matter that we were not physically there, none of that. And this is much before anyone had thought of outsourcing research or offshoring research or anything of that kind. So that was so that was one step. I've been covering all the global stocks for since then.
Yeah,
So
almost 20 years maybe.
25 plus.
25.
So 99, 2000
Yeah,
since
yeah, yeah.
then. So, but the next step, beyond a point, it gets a little frustrating being on the what is called the sell side, which
Yeah.
is broking and investment banking, because you're trying to convince the fund manager to pull the trigger.
Yeah.
So, for example, I remember during 2008-9 going to all the fund managers saying that this whole infrastructure company boom, because this story also comes every few years. If India has to prosper, infrastructure companies have to
Yeah.
do well.
Yeah. Yeah.
So I said, like, look at what's happening to the return ratio. This sector is headed for a disaster. But very few fund managers actually reacted to that. So beyond a point, as I said, it gets frustrating. So then you say that I want to take the decisions,
Yeah.
and that's how. So we started with the global fund management in 2015, so about little over 10 years now. And the PMS we started once we had a system. So that was 2000. Sorry, 2020. So that was
And fairly successful, I must say.
yeah. I mean, we were like on a risk adjusted basis, though we are like really good till about a year ago. Even on a general multi cap basis, we were right on number one. But again, our first thing is to manage risk tightly. So we never took it, and we could see the momentum, but we didn't want to take exposure to very small stocks. So, so for that reason, the year when your performance lagged those who went aggressively into small caps.
Yeah. Great. I think that's it. We are at time. So thank you again so much, Devina. And hopefully, when is the next book coming?
I've actually started work on that.
Okay. So, and I think you kind of mentioned it at the beginning of the book that the second one will be slightly more autobiographical in nature.
No, that's not what the second one is. Maybe someday I will do that, but
Yeah.
that's not the second one.
Great.
That one is still on investing.
Great. Thank you so much for coming, and I look forward to seeing you again.
Thank you. Thank you for having me.